So in this video, I'm going to break down why 99% of all companies on earth do not make a true economic profit. You see, everyone is fighting an invisible enemy. Whether you like it or not, you're taking on an invisible force. In this video, I'm going to transition you from being the hunted to the hunter, because I've came up with a filter method where we can identify the 1% of companies that do make an economic profit, because this is where the capital should be invested. Companies that are generating true economic value and economic profit. You may be familiar with the Bessembinder peer-reviewed study where 96% of all companies on the stock market could not even outperform a treasury bill. So do you know what this did to the civilians that hear that? They think, okay, wow, only 4% of companies actually can outperform a treasury bill. So this is like finding a needle in a haystack. This is going to be so difficult to actually find the companies that do, when it's the complete opposite. These 1% of companies that are actually outperforming the market and making true profit are companies we already know. They're the largest companies in the world. These are huge monopolies with massive pricing power. They are not a secret. They're glaringly obvious, in fact. We can find them through a filter system. Why is it so important to only invest money into these companies? Because otherwise it's going to stop us from making more mistakes. It's more important to not lose money. If we're only invested in these companies that do generate the economic profit, we have a less likelihood of losing any capital. See, this algorithm, it applies to all investments in all businesses. It is a well-known, well-established algorithm. It is simply return on invested capital minus the weighted average cost of capital. That sounds complicated. Let me make it extremely simple. If you take a $100,000 loan at 8% interest rate from the bank, and you decide to invest that in a business, and you spend that money on equipment and marketing and whatever it may be, you know that your return on invested capital must beat 8% interest of the loan. Otherwise, what is the point? When it comes to loans, it's very easy to understand. There's a big problem here with people that use their own capital, their own money. They think the cost of capital is zero. It is absolutely not zero, because little do you know, you are standing on a treadmill. The treadmill is moving 7 miles per hour. That is your hurdle rate. Where did I get 7 miles an hour from? In 1959 in America, all dollars in existence was $286 billion. That was it. Today there is $22 trillion. This is why everything feels expensive. Because there's too much money. There's too much dollars. This is by design. Because there is a sovereign debt crisis. And there is no way to solve this apart from inflation. So to make it extremely simple, more dollars needs to be created. And the value of the debt will shrink. That is it. We are all fighting the true enemy, which is money being created. That is your true enemy. That is your true hurdle rate. If you do the math from 1959 to today, it's 6.75% to 7% average over the course of time. And it's only going to expand more. It expands every year. Commercial banks and the Federal Reserve are creating money. So even if you're invested in a business or an asset, your purchasing power is being eroded. You have been lied to from the CPI. I always talk about this on this channel. Consumer Price Index, the cost of bread, milk and eggs is calculated at 3%. It does not factor in the M2 money supply, M2 money expansion, dollars being created. So if you're only yielding 5%, while money's coming out at 7%, you are going backwards. The treadmill is defeating you. This is why people are working until they're 75. This is why people cannot retire. They were never taught this information. They were not aware of it. They think, and a lot of people feel like they can just simply invest into the S&P 500 and do nothing and everything will work out. Well, as I said in previous videos, if the S&P 500 is returning 10% on average, conservatively, depending on when you invested, because we know that if you invested in 2000, there's at least 13 years of low returns because of the dot-com bubble valuation issues. But let's just say, fine, it's 10%, and money's coming out at 7% every year, you're only making 3%, then take away taxes, you're standing still. It is now, financial literature is no longer just, it's now a requirement. It's now a requirement to understand this if you want to have economic survival. So I've got a solution for this. I know how to identify the 1% of companies that make true economic profit. And I'm non-negotiable on my requirements. If the company doesn't meet this, then I'm not going to invest in the company. Goodwill adjusted, cash return on invested capital, 30% plus. See, if a company can do this for 10 years, I know I've found a true monopoly, a true company which is making economic profit. Because the laws of capitalism is like gravity. If a company's making 30% return on cash invested, naturally what's going to happen is other companies are going to copy it, undercut it, compete against it, and fight. If the company's held that for 10 years, that's when we know it has true pricing power, it has true moat. So that's the companies I'm looking at. Pricing power under pressure. The moat must be operationally impossible without it, or structurally permanent. Free cash flow must be 90% of the net income. It must obliterate the M2 money supply year over year, so it must beat 7% or however much the money supply expands that year. And of course, to make sure we're not overpaying for it, I want to make sure the PEG is under 1. Okay, that is my own filters. Naturally, the companies that meet that filter are the same companies in the Bessembinder study. They're the 4% that actually beat a treasury bill. They are not a secret. It's not like finding a needle in a haystack. We're not acting like venture capitalists trying to find a moonshot. These companies are in a position where they'll soak up the new money that gets created. When new money gets created, it goes into a queue. You want to be first in the queue. If you're a wage earner on a salary, you are last in the queue. By the time the new money gets to that person, asset prices have already went up. The Cantillon Effect, that is the name of the economist that created the theory behind the Cantillon Effect. Money goes to the closest to the source first. All the monopolies, all the strongest companies on earth, they are first in queue. And we can become first in the queue if we own these assets, if we own these stocks. A great example of a company that might meet this requirement, two companies come to mind. Off the top of my head, Microsoft and Broadcom. You see, on this channel, I'm always talking about Broadcom. It's one of my key main investments because it has actually beat this filter for 10 years. Before the AI boom, before anything, this company was already performing 30% plus cash return on invested capital, obliterating the money supply. It's always done it. And Microsoft as well. Microsoft's another company that does it. See, another thing that's not on there as well, B2B companies. I invest in B2B because the only a business to consumer company, it just physically cannot have pricing power. A good example is Netflix. If Netflix just said tomorrow, the cost of Netflix is now $300 a month, they would probably lose like 90% of their customers. And the customers would say, you know what, we can just watch YouTube for free instead, so let's just do that. There's no pricing power. There is no pricing power there. They have to make up the money somewhere else. That's why they use advertisements, that's why they use other methods and strategies. If Microsoft said, we're increasing prices by, 20%, the Fortune 500 would fire their staff before they would try and switch away from Microsoft. It's so deeply embedded in their systems that they have almost no choice but to pay. That is what I call operational impossibility. My other video regarding Broadcom, VMware, the software that the Fortune 500 also use, Broadcom was able to push the prices up over 1,000%, and they would still have to pay it because they were so deeply ingrained in this software that there's no way out of it. They had put their own handcuffs on by not diversifying their software. So these companies absolutely exist. These companies will obliterate new money supply. In fact, they benefit from it. You can benefit from it too by owning the correct assets, by using this filter. It's never been easier. We must be using AI. You can use Claude, you can use Google Gemini, and you can put these filters in. If you're looking at a company, if you're looking at an investment, this is your hurdle rate, this is what you're looking for. Does it meet these requirements before you make an investment decision? Yeah, that's what we're about on this channel. We want to find companies that are generating a true return, because this is how you change retiring in 40 years right down to 10 years. When you're invested in the right companies that are making the true economic profit. Leave a comment on the video, subscribe to the channel, and look into the description for ways that you can contact me and we can look at your investments, look at your businesses, find out if they are making a true economic profit.